Last quarter, we talked about the possibility of recession. As of right now, it appears the odds are increasing that we'll have recession in the U.S. and maybe some other countries around the globe. Now, as you're aware, the Federal Reserve increasing interest rates to fight this 40-year inflation that we're seeing. Those rates are having their desired impact. They're cooling the economy, and that's good to a point, but the Fed is now trying to engineer this Goldilocks kind of scenario where they achieve what they call a soft landing, where they slow the economy enough to bring inflation down, but they don't slow it so much to push us into recession. So we'll see whether that's the case or not. Now, the quarter ended in June marked the second quarter of declining economic activity. So by definition, that's a contraction over 6 months. That's kind of the armchair quarterback definition of recession. It's not been officially declared, just to reiterate for the people keeping score at home. The official arbiters of recession define it as a significant, widespread, and prolonged downturn in the economy. Now, when you look at any number of economic indicators, some of those words are being used to describe. There's a few places where it's not, namely jobs. Over 2.7 million jobs were created in the United States in the first half of this year, and it would be really rare to have an official recession declared with such a strong job market. We've got unemployment at record lows still. Corporate profits hit all-time highs during the second quarter. And so that's also something that you would normally see coming down during recession. Now, in the case of jobs, that's very much a lagging indicator. So by the time we would start to see layoffs and the like, we would probably already be in the recession. So we'll see if that begins to move up. I want to go back to one thing Don was talking about earlier in his piece about bonds. And if you look at this chart, again, of the yield curve, this picture of what interest rates look like, again, the blue line is rates a year ago and what they normally sort of look like, an upward sloping line where lower rates on shorter term loans, higher rates on longer term loans. That's sort of normal. The red line is where we are today. And as we discussed, that's good news for bond and cash investments going forward, but it's not so great news usually for the economy. Economists like to call this an inverted yield curve. That's just a fancy way of saying that short-term rates are as high or higher than long-term rates. That's not a great scenario for bank lending, for other arbiters of the economy. And so we're watching that. If you want to look to something that would indicate we're having a recession, that's a fairly good indicator. As a sort of validation of that, since post-World War II, every recession we've had in the United States was coincided with an inverted yield curve. Now, we have had an inverted yield curve without having the recession a couple of times, but most of the time that's not the case. So at any rate, at this point, a recession, if it comes, it feels a lot more like a normal sort of business cycle run-of-the-mill recession to me, where the economy gets too heated up, the Fed raises rates to cool it down, it gets too cooled down and goes into recession. That we don't see, again, that crisis type situation like the '08 housing market John talked about, or the pandemic in 2020 and what we saw happen there. So then somewhat encouragingly, the Atlanta Federal Reserve Bank publishes what they call GDP Now. It's kind of a boots on the ground, real-time measure of economic activity. It's very volatile and it gets revised a lot. But as of right now, it's predicting fairly strong growth in the third quarter. So we'll see what happens. But at any rate, the important thing for investors to think about, whether we have a recession or not, and we know we will eventually, it's an inevitable part of the business cycle, but what do we do about it as investors? And here's two things to keep in mind. First, as you can see here, the economy spends a lot more time expanding than it does contracting. The average expansion lasts almost 4 years in the United States, the average contraction just about a year. So if we do have a recession, they're typically not very long-lived. This too shall pass. The second thing to remember is the markets are always forward-looking. And so just as they have turned down right now, year to date, perhaps in anticipation of a recession, so too will they turn the corner and start rising before a recession has come, and usually before it's even been declared. So this is good news. According to researcher Morningstar, since World War II, the average return on stocks 1 year after the recession is over 22%, and it was positive each and every one of those times historically. So whether a recession is imminent or not, the advice for investors is similar. It's stay diversified. It's don't panic and sell out. And it's take the opportunity to rebalance into stocks while they're on sale.